So here we're just going to touch on the Europe a little bit. They had a lot of different data points, and it's tough just because obviously they're on lockdowns, they're on COVID restrictions, so some of the data is a little messy. But we'll go through it in a bit more depth and try to capture some different pieces. But before we get into that, please like, share, subscribe. If there's anything specific you want to hear about Europe, let us know because there's a lot of data points, and because there's country level, Eurozone level, European Union level, there's a lot of things that we can touch on. So we'd love to know what you'd be interested in, and we can talk about it because I look at it all. It's just I try to pick out stuff that I think is interesting. So if you think something is important, I'd love to hear it, and we can include it. So here, when we look at the Euro area GDP, and when we look at quarter over quarter, so it came in at 12.5, a little bit above expectations. Year over year, it's down 4.3%. Again, this isn't surprising considering where Q3 was, the amount of stimulus that came in. The problem is going to be Q4, where Q4 estimates, as we've been talking about, have already shifted negative and gotten reduced down. There's been some pickup, as we talked about, with the amount of debt that the ECB owns. The Financial Times had a bunch of articles, and the essentially Lagarde has come out and said that she's going to do more to support the recovery, which is just going to include trying to weaken the euro, trying to purchase more debt, as we talked about in segment one, looking at the amount of debt that the ECB is going to be purchasing. These are things that they're trying to do to essentially knock down and try to strengthen try to weaken the euro. And the reason why you weaken the euro is because you want to generate GDP. How do you generate GDP? You increase your exports, you make you try to adjust your imports, you try to incentivize consumers, you try to just move things along. And sometimes an easier way to do that is with a weaker currency, because then it makes your exports more affordable. And that's, I think, the biggest driver. So this is a look back, and then some of the data we have coming up is going to be a look forward. So when we look at trade-weighted euro, so we had a big show on this previously, and I thought it was really, I was proud of it. Some days I finished in a segment and I'm like, that was an okay show. Like I was actually really proud of that one. And here's something similar. So when we're looking at the euro dollar, the rates and why it matters. So the trade-weighted euro, you can see it continues to trend higher, especially as we see the euro dollar continuing to move up as it pulls everything up. And the reason why is the euro USD, the dollar continues to weaken against the euro. ECB estimates in terms of where they want to hold it, which is about 118. I would argue they'd like to get it back to 110, but again, there's only so much you can ask for. And the trade-weighted euro continues to strengthen as the dollar has weakened. Euro has strengthened. That's starting to adjust a little bit today, but again, the euro still remains strong. It's only down about 3 pips. So there's going to be a drive to adjust this because they want to knock that down below that red line, try to incentivize more exports because, who is their strongest economy? Germany. What is the German economy? It's an export economy. So if you want to incentivize people to purchase, they need to have the ability to do so, because as their currency, as the emerging markets and advanced economy currencies strengthen against the euro, they can buy more, it becomes more affordable, and then move stuff through the system. So these are things that are going to be close and going to be very important, and it is something that the ECB is watching closely. The question is going to be how? How do they go about trying to knock down the currency? How do they go about weakening it to try to incentivize more trade? We all know what they want to do, but how will they do it? It continues to be that question. But let's now look at some of the data points. So the PMI data has come out. We have some CPI data as well, as we can go through in different pieces. But there's so much data and it's so spread across that it's hard to show the different pieces in charts. So here we're just going to talk about this in pieces. So Spain, again, like the survey, things were outpacing the surveys. Italy continues to soften, as we saw with the high frequency demand issues. France continues to see essentially a slowdown overall. Again, composite was a little bit better. Germany's the one that continues to outperform, where German composite was actually still in expansionary territory. And as we've said before, 52 and 48 in that comfort zone. Yeah, below 50 is contractionary, above 50 is expansionary. But if you're in that level, it's minimal. Like there's going to be, calculation errors. There's going to be some issues. So when we look at the rest of Europe, they're clearly in contraction. And when we look at Germany, we can say that, okay, well, services are weak, which is kind of the story across the board. But the German composite remains expansionary. It's missed estimates, but it's still moving in the right direction, where European services massively, well, I shouldn't say massively, but in a contractionary level. Eurozone composite continuing to contract, which is why when we look out, because this is November, December, based on the high frequency data that we keep talking about, the daily activity, France has improved, but Italy and Spain have gotten worse. So again, we're going to see negative growth again in Q4, which is something that has to be addressed, or that will be addressed in the ECB meeting. Retail sales surprised to the upside across the European zone. Month over month was expected plus 70 basis points, came in at 1.5. Again, this is October. November will be different as we see the impacts from COVID, lockdowns, and all those other fun things to look at. But factory orders for October, same thing. Like that's why some of the data, a little bit of a look back, factory orders were trending in the right direction in Germany. Factory orders continue to drive. Industrial production moved up. The issue is going to be, where do we sit post lockdowns? What does November look like? Because yes, like the beginning of October didn't have lockdowns. So yes, we got them at the back half of October. They accelerated into November. So it's going to be interesting to see how does November really shake out and what does December look like, because we look at things on a high frequency level. We're trying to show you things in real time, and they continue to be very weak. And means, which is why we're so concerned as not only we go into the end of the year, but into 2021. But when we look at CPI, CPI year over year was down 1.1%. CPI was up 0.1% month over month. It's just German. It's going to be interesting to see what this production looks like and how things are essentially shifting over time, because industrial production in different areas continue to be massively negative, and we continue to see these fears where we have like German exports were down. So they were expected to be 1.3%. They were only up 0.8%. Imports were supposed to be 1.2%. They were only up 0.3%. Again, this is the slowdown that we're talking about. The euro strengthening is going to impact that, which is why we're seeing, because Germany needs a softer currency. And when we look at current account balance, it's still positive and it beat estimates, but exports still missed. And exports missing is a much bigger hit to the German economy than it is to the U.S. economy, given the way we're structured. And these are why we look at the specific things. Unfortunately, this came out this morning. I didn't get a chance to build that and put it into here. It'll be in our report that's coming out on Friday. But again, these are things that we're looking at that are continued to weigh on just general economic activity. Now, with that being said, the spreads don't tell you that. The spreads look like everything's fine. And you can look at the ECB expansion. Like Portugal is now trading at 0%, first time ever. Italy and Greece is kind of converging above that 1 point, let's call it 125 basis points. Germany is negative. There's negative yield. So there's going to be pressure in terms of what can be done next, because you can see the tightness in the spreads. You had the fear factor coming in at the beginning of the year. Now the ECB is so active. They're essentially streamlining and smoothing out some of the risk, which is why the euro continues to strengthen. So if the euro continues to strengthen, how do you weaken it? What can be expanded? The PEP expanded to 1.35 trillion. Poland and Hungary are against the current European Union budget. That's going to be an issue because it's supposed to push out some more support. That's going to be something to watch. But again, if you look at spreads, the spreads would tell you there is no risk. The COVID GDP economic data tells you there's more risk than is apparent. Again, these are the conflicts that we continue to see in the market, and why do we have the stock market going up? Because I'm gonna own Portugal at negative yield. Like why? Like why wouldn't I just own Apple? Why wouldn't I own? And that's why you're getting people pivoting from essentially bonds into equities, and again shift that liquidity. The flood of liquidity going into the stock market is continuing to prop us up and push us to these highs, and these are the pressures that we continue to see. Again, the ECB meeting will be important. Unfortunately, this will come out after that, but we'll have an update on what that means and what we think it's the impacts it'll have over the longer term for the most part. Now that we've covered Europe, the next segment we're going to pivot more and look at Asia, Asian stimulus, and really an update on Chinese trade.